Market news now. Stocks in Asia struggled for direction as concerns over the economic impact of the Omicron COVID variant continue to weigh on investor sentiment. Hong Kong's Hang Seng Index rising 0.5%, reversing earlier losses. Mainland Chinese stocks closed in negative territory, with the Shanghai Composite falling fractionally. European markets pulled back as concerns persisted over the Omicron COVID variant. Data releases include the Eurozone unemployment rate for October and the producer prices for the same month. Looking at things stateside, U.S. stock index futures rising in early morning trading following a tumble on Wall Street after the CDC confirmed the first known case of the Omicron variant in the U.S. To give us some more perspective, we are joined by Gary Booysen, who is from Rand Swiss, talking to us from snowy Switzerland, I hope. I mean, can you imagine from your side, it's either you're planning on returning or perhaps creating a snow angel. So what's the situation on your end?
Yeah, so obviously with the Omicron-led travel disruptions, we have become stranded in Europe, but it does look like flights to repatriate South Africans are now back up and running. So just a matter of getting the administration organized so that we can return to South Africa, because looking at the figures, certainly in Switzerland, where I am at the moment, is the cases are rising very, very aggressively. So this isn't a South Africa-only issue. This virus has gone global, and we're certainly seeing in the European economies that lockdowns are coming. We've Switzerland holding off at the moment, but we've seen Austria locking down heavily.
So what's the market sentiment, right? Because I can imagine it's a little bit different from what we saw on Friday, or as other analysts have called it, Black Friday for markets.
Yeah, so if you look at Friday was an aggressive sell-off based on what looked like a knee-jerk reaction to the announcement of the travel bans. But with the big recovery that we saw on Monday, we saw the travel and leisure index up over 5%. We saw the likes of City Lodge and Sun International, Tsogo Sun, all our hospitality stocks, recovering strongly. But as the weeks played out, the volatility has been exceptionally high, and you get the sense that we're not quite through this. On the one hand, some of it is the central bank action we've seen. We've seen a far more hawkish Fed with Jerome Powell, testifying in front of Congress. But at the same time, there's a lot of moving parts, because we've also got all sorts of ructions in Turkey, which could be feeding into our local currency. But our local currency obviously also very, very subject to that risk on, risk off trade. And if you look at just the rand dollar pair, we've been all over the place this week. We've been well above 16, almost down to 15.75 at one point, back to 16 this morning as we saw stocks selling off again. So the recovery that looked pretty solid on Monday has definitely become shaky as the week has worn on.
So the one story that I found quite interesting relates to Capitec, and we're going to put that graph for our viewers to see the 10-year chart of how Capitec has progressed. But the story headline reading that Capitec racing past Standard Bank to become South Africa's number 2 bank. What kind of growth are you seeing when you look at Capitec versus the other banks?
No, so there's no question from a shareholder point of view, Capitec has been an incredible stock to hold, as you can see, over the last 10 years. And part of this is because of the growth story that sits behind Capitec. Obviously, it's penetrating an unbanked market. It's coming to the banking world with a very unique offering, in that it has this low-cost offering. Generally, they have longer trading hours. And what that's created, certainly I think in the mind of foreign investors, which are fairly active in the stock, is that it's a growth story on Africa, and it gets good institutional support. So Capitec, yes, it did now move ahead of Standard Bank in terms of market cap as the second largest bank. But I think you've got to put that in context. Capitec has always traded more like a retailer than a bank. Our banks trade on fairly low multiples compared to our retailers, which are very popular among overseas investors and trade on extended multiples. So yes, while First Rand has the highest market cap, just north of 300 billion rand. Capitec Capitec now, pipping Standard Bank above 200 billion rand, it's important to understand that measuring the size of a bank is not just about how much it's worth in terms of its stock market valuation. It's also how much does it have in terms of assets on the ground. And if you look at the assets, Capitec still lags a long way behind our big four banks, with Standard Bank actually being the largest bank by assets. And then, of course, another way to measure the size of banks is how many customers does the bank service. Now, types of customers is important, but if you actually look at retail customers, Capitec making significant headways in the retail market in terms of absolute client numbers versus some of the other banks. So yes, it is technically on the market our second largest bank, but just apply a bit of thought to that one as well, and think about like what kind of business Capitec is compared to some of our bigger banks.
Another one that caught my attention, and this was on the back of its SENS announcement, was Rebosa's property fund. And we're going to get that graph again for our viewers. This one, founded in 2010, at the time, first black-owned managed property fund to list on the JSE. What's gone wrong with this particular one, given where it was, if you look at 2017 versus where it's currently trading?
No, absolutely. The property market and the property story itself is very difficult in South Africa. And if you look at a lot of the property REITs that came on in the REIT listing boom of around, it was around, I'd say 2010 to about 2014, 15. Every second day we were getting a new REIT listed on the local exchange. A lot of that has unwound just because, South African property has in a fairly tough space. The likes of the coronavirus and what we've seen over the last 2 years has put enormous pressure on property companies. So Rebosa's, yes, it is a very geared play to the property market. Their whole focus is on deleveraging currently. They're in a little bit of trouble, have a little bit too much debt on their balance sheet. That's why they're not paying a dividend this time around. It'll be the third year that they've forgone their dividend. And that's really because a property REIT has a prerequisite in terms of solvency and liquidity before it can pay out to shareholders. So the company trying to deleverage itself, it's hiving off its kind of non-core operations just to try and, I suppose, survive a very, very tough time in the property industry.
All right, Gary, thank you so much for your time. That is Gary Booysen from Rand Swiss. Other news that market analysts and, of course, traders will be keeping an eye on is the OPEC Plus meeting. We are also expecting speeches from Presidents San Francisco and Richmond, and not forgetting those U.S. weekly jobs claims.